Hey everyone, welcome back to the channel where we make money talk make sense. Today we're tackling a question I get asked all the time, especially by people approaching retirement. Do annuities protect against market risk? The short answer? Yes, some of them do. But the full picture is a bit more nuanced, and that's what we're unpacking today. Just to clarify, we're talking about fixed annuities and fixed indexed annuities. Let's be honest. If you're watching this, you've probably felt the sting of market volatility. Maybe during the 2008 crash, the COVID dip, or even just last year. And now you're thinking, I've worked hard, I've saved, and I don't want to risk losing what I've built. That's where some annuities come in. They're designed to provide a level of protection and guaranteed income that many retirees find reassuring. If that's something you're curious about, stay tuned. We're breaking it down in simple terms. Quick reminder, this video is for educational purposes only. I am not a securities licensed advisor and do not provide investment advice. At their core, annuities are insurance products, not investments. You give a lump sum to an insurance company, and they make promises in return, often guaranteed income, sometimes for life. But different types of annuities behave very differently in how they handle risk. We'll be focusing on fixed annuities and fixed indexed annuities. Variable annuities, which are considered investment products, require a securities license to offer and won't be covered here. Let's walk through the three major types of annuities and how each one handles market risk. Think of fixed annuities kind of like a CD, but from an insurance company instead of a bank. You get a guaranteed interest rate and know exactly what you'll earn. There's no stock market exposure, so no market upside, but also no market downside. If safety is your top priority, this is one of the most conservative annuity options available. Then there are fixed indexed annuities, or FIAs. This is where things get a bit more interesting. With a fixed indexed annuity, your returns are linked to a market index, like the S&P 500, but you're not actually invested in the market. Here's how it works. If the market goes up, you receive a portion of that gain, based on a cap or participation rate, which varies by product. But if the market crashes, your return could be 0%, but never negative. That floor of 0 is the key. You won't lose principal due to market drops, but your upside is limited. It's a strategy that offers protection with growth potential, which appeals to many conservative retirees. Now, variable annuities. These are investment products that are tied to the stock market, and they do carry market risk. Because they're considered securities, they can only be sold and discussed in detail by licensed financial professionals. The value of a variable annuity can go up or down based on market performance, and some may offer optional riders for additional benefits. But these vary by provider. If you're considering a variable annuity, it's important to consult with a securities licensed advisor who can explain the pros, cons, and any fees involved. A rider is like an upgrade package you can add onto an annuity, and it usually comes at an extra cost. Common riders include things like guaranteed lifetime income, enhanced death benefits, or protection features that reduce the impact of market volatility in certain types of annuities. Some riders are designed to provide a steady stream of income in retirement, regardless of how the underlying index performs. These benefits typically involve an annual fee, which varies by product and insurance company. So, do annuities protect you from market risk? Fixed annuities, yes, fully. Indexed annuities, yes, to a degree. Variable annuities, not typically, unless optional features are added, and those require a licensed financial professional to explain. Here's the reality. The more protection you want, the more growth potential you usually give up. There's no such thing as high returns with zero risk, and any product that promises that should raise red flags. For many retirees, certainty is worth more than potential. I've seen many clients gain peace of mind from annuities with built-in protection, but I've also seen people get stuck in contracts that were too complex, had high fees, or didn't match their goals. So before you sign anything, read the fine print. And better yet, work with someone who can explain it in plain English. If you're exploring whether an annuity makes sense as part of your retirement income plan, Casa Arteaga Insurance is here to help. Our team specializes in simplifying complex financial products and tailoring insurance-based solutions to fit your unique goals. Whether you're seeking predictable income, protection from market risk, or a balanced plan for long-term security. Don't leave your future to chance. Reach out to Casa Arteaga Insurance today via the number on your screen or the scheduling link in the description below for a clear, honest conversation about your options. Different annuities can protect you from different market risks, but only if you pick the right one. Understand the trade-offs. Ask questions. And make sure the annuity fits into your broader retirement income strategy. If this video helped clarify some things, give it a thumbs up, and don't forget to subscribe for more practical financial guidance every week. Got questions about annuities, income planning, or just want a second opinion? Call us today. We're here to help. Thanks for watching. I'll see you in the next one.